But the president continues to dominate the headlines. We're in the middle of a transformative period for the economy, too. Investing norms, are they getting flipped on their head? Or is high valuation here to stay? Is growth still the backbone of this market? It's not a clear answer, given some of the problems of late. Or is a rotation to value on the way? It's early in the year, but look at the Vanguard Value ETF. It's outperforming the Vanguard Growth Index. Is that just a hiccup or an emerging trend? Joining us now to discuss and maybe debate, Cole Smead, is CEO and portfolio manager at Smead Capital Management. And Chris Crisanti is here on set with us. He's the chief market strategist at MAI Capital Management. I think of Cole as a value guy, but Chris, I sort of think of you as a value guy, too.
It's true. We're going to be singing to the choir today.
Okay, value versus value. What kind of value stocks are you in right now?
So I'm really liking healthcare here, Kelly. Over the last 2 years, the S&P's up 54%. Healthcare sector's up 2%. So, and the earnings have come through. And with all this Trumpian angst, what we're looking for is reliable cash flow, reliable dividends, and that all kind of feeds into cheap healthcare stocks.
Are there any growth stocks that you would look at? What we would traditionally call growth stocks, but
sure.
You know, I know you're often looking for a bargain. I don't know if there's many. Microsoft has been a little bit of a more challenging story.
Right.
Some of them have lower valuations. Anything there?
Well, and I'd be careful. I mean, it's kind of a not correct that value investors don't like growth. Love growth, just don't want to pay a ton for it. So I love Google. Google, at least until it had its recent run, was the only Mag 7 stock that was selling below a market multiple. So it's nice to go there. Love to have both growth and valuation. Don't get it a lot, but there's still some out there.
Cole, I don't take you as the type who's like all that excited to comb through the Mag 7, ever, or at least at these valuations. Where are you looking right now?
Yeah, thanks for having me, Kelly. I think a really interesting theme that we're going to dig into a lot more in discussion with investors is talking about asset-light businesses who produce low returns versus capital-intensive businesses that are producing attractive returns. So let's just use your discussion a second ago of Meta. If I back out the stock-based compensation out of what the street expects Meta to make this year, they're not going to make $43 billion in free cash. They're going to make $26 billion in free cash flow, a 40% reduction because that's how much stock-based compensation cost them last year. Now, that's still a lot of money, admittedly, Kelly, $43 billion. But when you compare it to the book value of the business at $180 billion, it means it's producing about a 15% return on capital when you look at cash returns. Now, that's fine, but when you trade it 8 or 9 times book, that's impossible to compound money. Now, why I say that, Kelly, is because I can go out and we, as our investors, can go out and buy oil companies on either side of the border that are producing mid-teens returns on capital with cash.
Yeah.
And so why would I go out and take that kind of risk? And ultimately, the stock market is functioning in a way where if your stock goes up, everyone rewards you and thinks you're more intelligent. If your stock doesn't go up, you're an idiot. And the problem is neither may be true.
But, Cole, here's where I get stuck, because I listen to your math and I go, well, that sounds sort of sophisticated and important. And then I just look at the performance and I go, I don't want to own energy stocks that go nowhere, right? Even healthcare,
Right.
a compelling argument, but until a few weeks ago, not much to show for itself. So how long am I waiting to see these returns? Or am I not? Is the price return not capturing it? Is it really total return? Do I have to look at the dividend? Or is it a matter of time?
Meta does higher CapEx as a percentage of sales than U.S. Steel does. That's bizarre because one's capital intensive and one is asset light. Kelly, never forget, you cannot confuse brains with a bull market. We're doing that, and ultimately we're doing that on the back of American exceptionalism, which is the largest debt binge in our history. We are not exceptional, we're the borrower, and that's what the rest of the world hasn't done. We're going to wake up just like we always do and find out we're human and we have folly, and our casino is just pretty big right now.